Welcome back to another episode of Investing Explained. Here's today's question. So I really like your question about ETNs because I think it's something that we really haven't covered. We primarily talk about ETFs here on the podcast, and those two are very similar in the sense that they're both designed to track an underlying asset, and they're typically very popular because you have a lower expense ratio than active managed funds. Now, the main difference between the two is really under the hood. When you invest in an ETF, you are investing into a fund that holds the asset it tracks, and then it trades that. With an ETN, it's more like a bond. Basically, you are buying an unsecured debt note that's issued by an institution. So just like a bond, an ETN can be held to maturity and it can be bought and sold. But you are depending on that institution. So if the underwriter of this would typically be a bank, if they were to go bankrupt or if they get like a credit downgrade, it will affect the price and value of your ETN, which is very different than what it is with an ETF. I think one of the advantages if you do decide to invest in ETNs would be that for tax reasons, sometimes it's better. They hold the fund until it's completely sold out, which is often years later. So you will trigger long-term capital gains tax. It can be a pain with some other funds with the short-term capital gains tax. But again, that might also be a part of the strategy of that fund that you rebalance often. And that would be the counter argument. And also another advantage is that it doesn't have any tracking area because you're basically buying this basket of whatever it is, say it would be commodities, and then it's sold off at the very end. In terms of giving a suggestion or providing a recommendation of what to invest in, I think it's very difficult because I guess I would say if you're not familiar or comfortable evaluating a bond and evaluating credit, I definitely wouldn't go for an ETN. So if you feel comfortable doing that and you like the underlying asset, I think it would be good. If that's not you, I would probably go for an ETF or another vehicle. That's, I guess, to most people, easier to analyze.
I completely agree with what Stig just said about ETNs. I don't own ETNs. I kind of try to stay away from ETNs just basically for the same reasons that Stig just mentioned. When you think about commodities, at least what I learned from Jim Rogers' book is it really comes down to supply and demand. In fact, I just had an interview with Bill Miller just past week. And that was one of the things I asked Bill was whenever he looks at whether he's going to buy a specific commodity or not, what's the main thing he's looking at? He said it's supply and demand. It's all supply and demand when you're dealing with commodities. So really comes down to finding a low-cost ETF for the sector that you're specifically going after, that you think that there's a supply and demand imbalance. I also feel that commodities are a great place to be if you feel like the dollar is going to be devaluing as far as a macro trend, which is one of my main arguments for why I think commodities in general, generally speaking, are going to do well in the coming year. Whenever you look at the different commodities out there, I think the big buckets are energy, agriculture, industrial metals, livestock, and precious metals. I think those are your big buckets. So if you're finding call it a ProShares or an iShares ETF in there, those are probably going to give you the lowest cost, the lowest fees to be in one of those. But again, make sure you go back and you're looking at the supply and demand globally is how I typically like to look at this, is like, what's the global supply and demand and what's things looking like if that's going to continue to persist. That imbalance, if there's an oversupply and under demand and you're seeing that trend continue, then you can position yourself accordingly for that. And I'm a huge fan of the book that you just mentioned by Jim. I think that that's the best commodities book I've ever read out there, just kind of talking about the best way to invest in commodities. So
I think commodities is an interesting play in terms of a hedge. I mean, if you just look at the returns, just by commodities in itself, it's typically not super appealing compared to some of the other asset classes, but it has a negative correlation to long-term bonds, close to 0.2, and negative correlation to stocks with closer to 0.27. So for that reason alone, it might be something you're interested in if you think that those markets are overpriced. And clearly, if not, you might take the reverse position. But that's one of the reasons why a lot of really good investors are holding it in the portfolio. There might be good reasons why you won't just say, oh, okay, I just don't want to be as exposed. You might have a lot of capital gains tax you'll have to pay if you decide to own less stock. So that might be a way to manage your risk. I guess that would be my take on it, that it wouldn't be like a long-term thing to hold for me, but it would be something that under right market conditions might be an interesting and appealing investment.
And I think another important part with commodities is really kind of looking at moving averages and looking at what the trend is for commodities. Stanley Druckenmiller, he often says that commodities move in about 3 to 5 year periods of time. So like if you start getting on a bull trend, an early bull trend with a commodity, historically those have moved in about 3 years. It'll continue to move in whatever that direction is. So like when you go back and you look at the last time the commodities market had a big bull run, that was the start of 2007 when interest rates were climbing, and kind of, in my opinion, a very similar dynamic to where we are today. And whenever you saw commodities really kind of melt down, you saw that kind of play out in 2014 through 2017. You saw commodities just get crushed. And so I think that you're kind of at a bottom. I think when you look at the price action of commodities, this is also where it's different than stocks, where a stock has a lot more variables to it, where you're trying to figure out whether the competitive advantage of each underlying asset's going to continue to be there, whether the business is moving in the right direction, whether developing new products and the R&D is being properly allocated. Like, you're looking at all these things to determine whether the trend of a company is going to continue to outperform the market. That's really difficult stuff. But going maybe to the simplicity of commodities is, if you look and commodities have been punished for the last 3 or 5 years, you're probably at a point, and I know this sounds really simple, but you're probably at a point where they're probably getting ready to do really well and probably perform pretty well. Because there's only so much price action that can happen for the price of oil or the price of cattle or whatever it might be. And so I think we're at one of those points in time. I'd say the sector that I'm most excited about in the 2018 is commodities, hands down.
That's it. Preston and I will continue explaining investing, so go ahead and hit that subscribe button.